We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is J.E.S, the author of The Real Truth About Inflation and previous guest of the show. How are you today, J.E.S?
I'm doing well, Tom. Thanks for having me back.
Great to have you back. And you and I have had some pretty lengthy discussions here over the past couple of days. And it's been really interesting to kind of play with some of these ideas back and forth. But one of the first things that we started talking about was your take on an answer to one of my previous questions on the show of how long it will take for this set of interest rate hikes to move its way through the markets and the economy. And you had kind of an interesting take on that. So maybe we could start there and take any little tangent along the way that we need to.
Definitely. And for those listening, the tangents, I'll try to keep them to a minimum. So the interest rate thing is, I think intuitively, most of us kind of understand that interest rates, the effect of them being implemented doesn't take immediate effect, right? It's not as if the Fed raises interest rates and the next day, all of a sudden the economy is hit with the impact of that. And so I think I haven't done all of the research in terms of why and the cause behind why, but supposedly, from my understanding, interest rates have a 6 to 9 month lag on average. Historically, if you look at a chart, I don't have the chart in front of me, but if you look at a chart from...
I just shared the one that you sent me.
Okay, yeah. So that chart there is an interest rate rise, or an interest rate, just the effects of the interest rates from the 1910 to 1929 and 1948 to 1965 and the 1910 to 1965 time periods. Mm-hmm. And on the left, you can see the basis points, the cuts and the raises. And then on the horizontal axis there with the months of how long it takes for that effect to occur, to really kind of take place. And so I think that I had seen another chart saying the average time period was 6 to 9 months, but there was a lag anywhere between 4 and 22 months or something like that. Really what that tells us is that the first interest rate, I think in March, that the Fed did, has just barely started to take effect in the economy.
So what areas is that going to start, let's say, manifesting itself? You know, I've talked to a couple of people talking about companies refinancing debt and how that ends up affecting their balance sheet and their projected earnings going forward. Where are some of the areas that starts ending up showing itself?
Right. So I think intuitively, again, you know, we know these things on a deeper level. We just kind of, it makes sense if we spend a little bit of time thinking about it. But I think to really explore it, I think the obvious answer to that is the over leveraged, you know, FTX is a great example, or, you know, any corporation that is over leveraged with either junk debt or just kind of misallocated capital. However they've financed their debt is going to put them in a position that exposes them to that short-term maturity rollover of commercial paper when they need to refinance, potentially, that they're refinancing at a higher rate. And assuming that they're an equitable company that's operating on some kind of model of normal standard economics, their input costs due to inflation are up. Their input costs due to labor are up. All their input costs are up, and their output costs of sales are essentially down. They may be, as we've seen, according to the sales numbers for something, for example, like Black Friday, saying that sales numbers are up, sure, the sales numbers themselves in terms of dollars or aggregate totals of the numbers themselves coming out may potentially at a higher figure may be correct, but does that mean that they sold more goods, or did they sell less goods at a higher price and the nominal value was simply just a higher figure? And so when it comes to these over-leveraged companies who are over-leveraged and do have higher input costs and lower output costs, and then all of a sudden need to refinance at higher rates, that becomes unmanageable. And so they either dip into illiquidity or just outright bankruptcy, right? I mean, that's the only logical conclusion that I can come to in terms of how that would manifest. What do you think about that?
Well, I mean, I'm on the same page, and you sent me kind of another sheet here, the Friedman lag doctrine, and part of it pulled out is there is much evidence that the monetary changes have their effect only after a considerable lag and over a long period, and that lag is rather variable. In the National Bureau study on which I have been collaborating with Mrs. Schwartz, blah, 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 we have found that on the average of 18 cycles, peaks in the rate of change in the stock of money tend to precede peaks in general business by only about 16 months, and troughs in the rate of change in the stock of money to precede troughs in general business by about 12 months. For individual cycles recorded, the recorded lead has varied between 6 and 29 months at peaks and between 4 and 22 months at troughs. So this to me just kind of points out that there is so much variability within this. And again, I just keep coming back to this idea that really we have yet to see what the real damage of basically the fastest, steepest rate hike in history, or in US history, is going to have on the markets and the economy. And, you know, to say that we are out of the danger of a hard landing, maybe being able to make a soft landing from what we see right now, being able to somehow avoid a serious recession. I think that there are so many factors that have yet to play out before we see what the consequences of that really are. And, you and I kind of got into a bigger discussion here the other day about the idea that maybe it was these rising rates that really contributed and catalyzed FTX to blow up. But the idea that there was so much cheap money and liquidity in the system to begin with was really what was able to foster that type of environment for schemes and or companies like that to exist in the first place, right?
Right. And so as far, I'll cover two aspects of what you said. The first about the soft landing, hard landing thing. In my opinion, we've already crashed. We hit the ground and we hit it hard. And they're telling us, don't worry, it's going to be a soft landing.
So what would you point to say that we've already crashed and hit the ground hard?
Well, first of all, I would look at the whole argument for why a recession is not already occurring. And historically, up until this time around, a recession was considered a recession due to 2 consecutive quarters of negative GDP growth, and that constituted a recession. So we had that. And then we had the third quarter that came out with supposedly positive GDP growth. But if you look at the actual figures, they used what's known as a deflator, and the deflator argued a 4% inflation rate. So they're arguing 4% instead of 8%. And of course, 8% is not the actual true honest inflation, right? I mean, if we're going to use John Williams' shadow stats inflation rate, we're somewhere closer to 16 or 20%. So they're arguing 4% and saying that the economy grew at a rate of whatever they said, 3.2 or whatever the claim on the GDP growth was. The other side of the GDP thing is that, what is it, a third of the GDP is wrapped up in spending. So we're saying that we grew our economy by spending. And of course, where did the spending come from? It came from borrowing. So you're borrowing to spend, and that equates to growth. I'm confused. So on that side of it, it doesn't make any sense to me. And on the recession side of it, the other element of it is with the unemployment component at 3.7 or 3.8 unemployment, 3.8% unemployment, is that those numbers are clearly a fabrication, because if you look at the number of available jobs versus the number of people actually working, I think Peter Schiff came out and said that that the numbers of available Americans capable of being in the labor force, 100 million of them are not working. So I don't know how that works out to 3.8% unemployment, but I guess if you're the government, you can use any statistic to manage that figure to be what you want it to be. In the case of, for example, if you're not looking for work, you're not counted as unemployed. I think you would mention something in our discussion the other day about another area. I forget what it was. Do you remember what it was that you'd said about how they're calculating unemployment? And
what Danielle DiMartino Booth mentioned the last time her and I spoke was the severance packages and how that still counts people as basically being employed. But, I want to push back a bit on that number of 100 million people not having jobs. Like, that's 30% of the US population, of complete population. That doesn't include working age people that are able to be employed. So, like, to me, just my knee-jerk reaction to that is that sounds way too high for an unemployment stat.
It absolutely could be. It's secondhand information that I heard when I was listening to one of Peter's most recent podcasts, and I generally tend to trust him when he puts out numbers like that. I don't think that he's pretty, at least up till now, he's been pretty trustworthy in his sourcing of his figures, his economic figures. And I didn't look into it because, again, I trust him. It could be wrong. I mean, it could be that, it could be not that. I think more than anything, the number itself may be, it's not insignificant or irrelevant, but that there's a component element of that where there's probably a significant number of people in just the US economy that are not working, but somehow are either being disregarded in the unemployment stats or are being included as employed, as you said, in the pension funds, or however you'd said that with the Daniel DiMartino Booth, that it's not really an honest examination of who is or who is not employed. And so my point is that the recession, the argument for why we're not currently in recession is because supposedly the unemployment figure is what they claim it is, which I just, at this point, anytime the government speaks, I just assume they're lying.
Yeah, I guess only time will tell. And even at that, we're probably not going to know about how these numbers are calculated, because there's probably going to be so many more pieces of dramatic information at that point that we're going to care about that will get probably buried. But this kind of goes back to a bit bigger of a discussion that you and I were having anyway about why the Federal Reserve in the first place thinks that they need to, that they should have the ability to set really the price of money. Setting interest rates is setting the price of money. How do you think about going back step by step as we have from, talking about how interest rates are going to work their way through the economy, what effects those are going to have, to talking about just the price of money in general, and the way that really, if it was a free market, we shouldn't be necessarily interfering at that point.
Right. So, I mean, we can definitely have a discussion about whether or not the central banks should be setting and fixing the price of money. I was listening to Jason Burek's most recent interview on Wall Street from Main Street with Zach Abrams. yesterday. I think it was. Today's Tuesday, December 6th. So it was Monday. And they were saying that by the Fed fixing interest rates at certain nominal values, what it does is it creates a bubble inside of the businesses or the individuals borrowing at that fixed rate, whereby those businesses or individuals can only equitably operate in an environment where that rate stays relatively stable to what they borrowed at. And I would definitely encourage anybody that wants to hear more about that to go listen to that interview. And they're going to, those guys explain a lot deeper that component of it. But yeah, this position on the some entity or agency can set the price of money and dictate the cost of borrowing, and that controls how the economy functions. From anybody that has any semblance of free market mindsets within themselves, that just screams wrong, right? Like, none of us can look at that and go, yeah, that makes sense. That it doesn't, it's putting your thumb on the proverbial scale, mm-hmm. and saying that whatever the number comes up is what is, and that try and argue with us.
So, Jess, when we think about the role that interest rates really play here, how do you think the effect that is going to have on inflation? We're trying to demolish or slow demand down enough to be able to supposedly curb the type of inflation that we're seeing. And considering that inflation is made up of or calculated by taking several different things together, then how is it that they can have the, let's say, the pinpoint accuracy, or is that what they are going for, that they're trying to get inflation down by taking that action?
Yeah. So again, Zach Abrams in that Wall Street for Main Street interview yesterday said that it was a great analogy, that he said that fighting inflation using interest rates is like taking a 12 gauge shotgun to kill a fly in your house. And that you would eventually get the fly, but at what cost? Mm-hmm. And what would be left standing in your house? For me, first thing that comes to mind is the Taylor rule. And this is a little bit of a warping of the Taylor rule, but the common usage of the Taylor rule, John Taylor invented the Taylor rule in 1993. And the Taylor rule, for layperson usage, essentially states that if you're going to use interest rates to fight inflation, that you need to raise the rate of interest above the rate of inflation. I think a lot of us know this intuitively, again, that makes sense, that the only way you're sufficiently going to bring down inflation is to make the cost of borrowing go above the cost of money, or above the cost. Well, I mean, because I think of it in that term, that the rate of borrowing has to go above the rate of borrowing, essentially. Because if you think about what interest rates are, interest rates and quantitative easing are almost two sides of the same coin. Because when you lower interest rates to, say, 0, you make borrowing exponentially easier, right? So it's mm-hmm. no cost to borrow, which means that tons of people are going to go borrow, right? Huge corporations are going to go borrow tons and tons of money. How does the Federal Reserve provide the currency through that borrowing metric, or that borrowing mechanism? Is they purchase bonds, right? So that's the quantitative easing component that allows currency to spring into existence, because they're supposedly drawing their ability to purchase bonds on an unlimited bank account or checkbook that doesn't have anything in it. And they monetize the debt, essentially, and they buy bonds and provide currency in exchange, right? Like, that's the simple explanation that I think most of us are familiar with. And so if you think about how quantitative easing works in relation to interest rates, the lower the interest rate, the higher amount of quantitative easing, right? So inversely, the higher the interest rate, the less amount of money printing that should be occurring. At least in my head, that makes sense that way. Mm-hmm. So if you have an inflation rate, which ultimately inflation is the quantity of the currency supply, either in circulation or just in existence. I mean, we can argue velocity or not, but if you have a quantity of currency in supply and you still have people borrowing, that's increasing the quantity of the currency supply, right? So if you have interest rates at 4, 5, 6%, but your inflation rate, your money supply, your currency supply rate is, call it 8, 10, 15, 20%, then you're stimulating, you're incentivizing borrowing because it's cheaper. You're basically saying, okay, you can go and borrow money in the future, right? Because that's what borrowing is, right? You're borrowing now to pay back later. Mm-hmm. And you're basically saying that the cost to borrow now to repay later is cheaper than the cost to use the money or the currency in existence right now, right? So the only way you're going to drive down the cost of currency in existence, thus inflation, in the immediate, is to make the cost of borrowing in the future more expensive than the present, which ultimately is what the yield curve is signifying, right? Anytime the yield curve inverts is basically saying that the cost to borrow in the immediate is more expensive than the cost to borrow in the future. And that signifies a recession because it signifies instability in the future and uncertainty economically. Mm-hmm. So people are more inclined to utilize the function of short-term borrowing, or, if you want to look at the 1 month, the 3 month and the 1 month treasury, that's basically currency, because that's money only a month out or 3 months out, right? We're not talking long duration maturity debt. It's almost immediate rollover, right? So that's currency that's going to need to be paid out plus an interest rate very soon. So anytime that happens, the yield curve is letting the which ultimately is, that will go back to that position that you had said about central banks or central authorities attempting to fix the price of borrowing at a specified rate that they place their thumb on the scale in relation to. If you look at the two-year treasury in relation to the Fed funds rate and you overlay them, you see that the Fed follows the 2-year, right? I think this is, for a lot of viewers, they probably know this and they're probably aware of it on some level. And if not, I encourage anyone that doesn't know that to go locate that. But the Fed follows the 2-year. And so as much as the Fed likes to argue and kind of present that they are in control of the cost of borrowing, they're really not. I mean, the free market, or the market, which is not free. I mean, the market is ultimately controlled by the Fed's member banks and the big corporations and Wall Street and the government and powerful agencies and individuals. So they are controlling the market, and the market is doing what they can, control it to do. The Fed follows the 2-year. So if the 2-year is at 4.6, then the Fed's position is that they need to get their Fed funds rate above the 2-year to significantly deter short-term borrowing in the immediate and ultimately long-term borrowing, and which in their mind is going to bring down inflation. Now, I push back on that because ultimately rate hikes do not equate to inflation fighting. And part of that is we'll go back to the Taylor rule, where one of the bullet points of the Taylor rule is that monetary policy is ineffective at negative rates when asset purchases are included. So we know that the Federal Reserve and other central banks around the world have performed asset purchases they have them on their balance sheet. They bought up mortgage-backed securities. We don't even know what else they bought. And they're using this to prop up the economy. And then, of course, they've bought, their bonds. And so those are the asset purchases side. And then we know that we're ultimately operating on negative rates because the rate of inflation minus the current rate. If you have 7.7% inflation, or call it 8% inflation, minus 4% interest rates, what is this? Negative 4%, right? So we're still operating on a negative rate. So monetary policy is ineffective at negative rates when asset purchases are included, according to the Taylor rule. And the Taylor rule adjusts its equilibrium rate, which I believe the central banks are calling the neutral rate, based on a divergence in inflation and real GDP growth. So we'll go back to what I said about GDP, a third of it being spending. So we're arguing that we're spending more based on borrowing more, based on we're arguing that we're going to bring down inflation by increasing GDP, of which a third is spending, and most of that spending is derived from borrowing. And borrowing promotes and increases inflation. And the inflation rate is not 8%, it's closer to 20%. So we're somehow going to bring down inflation by raising interest rates. According to the Taylor rule, that's not possible.
Yeah, and I guess the only argument against that would be that if people don't have the money, this kind of gets into that wage price spiral piece that so many guests have touched on, that if wages keep up, then people still have the ability to pay those higher prices. And of course, the cure for high prices is high prices. And that means demand destruction, where people no longer have the ability to pay those higher prices. So there's just so many different factors that we need to consider that really at times just get kind of skipped over and forgotten about, right?
Right. So the wage price spiral, again, I look to Peter Schiff as, kind of the ultimate de facto economist that kind of understands economics better than anybody on the planet. Whether that's true or not, for me it is. He calls it the price spiral, because wages are prices for the employer, right? So that's a cost for the employer or the producer or whoever's, paying that wage. So as you said, the cure for high prices is high prices. That's true as long as your productivity increases. Because if your productivity increases, you increase your supply and you're paying people more to produce that increased supply. And that's ultimately what brings down your prices. It's not that prices bring down prices. It's that you pay somebody more money to produce at a higher rate. They produce more abundance. The more abundance allows the supply-demand curve fall relative to demand. The supply is higher than demand, prices fall. There you go. Problem solved, right? But if you're paying people more money to be less productive, you don't get the outcome of higher prices being the cure for higher prices. What you get is higher prices as a result of higher prices.
Mm-hmm. Yeah, and it's such an important point to really, I guess, drill in upon. And let's say the other side of this, if we're not talking about goods, but we're talking about something like energy that ends up being scarce, like we're seeing in Europe right now, the supply chain root cause of inflation, how does that get fixed? Somehow we need to incentivize energy companies to start drilling again. And granted, they're getting, we see in the news that they've had record profits, yet they're not reinvesting. And it's like, well, of course not. If you're being threatened by, in most of the jurisdictions that need your energy, why would you want to be reinvesting in those particular jurisdictions? So how does this supply side inflation piece really matter and make the difference at this point in time?
Okay, I want to answer that. I do want to go back to what we were just talking about real quick. Mm-hmm. And the higher prices is the cure for higher prices. What I said about the increased productivity equating to lower prices as a result of higher prices because you're paid more, that's true in the case of there being higher prices or higher wages so that you can keep up with demand or keep up with the prices of goods and services. Mm-hmm. If you increase wages and decrease productivity, what you're doing is COVID all over again. You are increasing demand. You're increasing the ability for individuals to buy or acquire the remainder of the limited supply
Mm-hmm.
when they're not being more productive. So you're giving them more purchasing power while keeping the rate of supply of goods steady, or it's irrelevant, the change being moderately irrelevant, because they're probably not going to be that much more productive. I mean, we would love to assume that if you're paid more, that you're going to be more productive. Maybe you are, maybe you aren't. That comes down to an individual case by case basis. So to say that somebody can just get paid more and then they can go out and purchase the limited supply of stuff, and that's somehow going to bring down prices, that's economically nonsensical, because the laws of supply and demand state that if you do that, prices will continue to rise. Now, to go back to what you said,
and I was going to say that perfectly ties in this next idea about supply chain root cause.
Right. So the incentivized structure for, we'll use energy because that was your example. They're being penalized or threatened anytime they demonstrate a profit. The governments are going to come in and issue windfall taxes or tariffs, or whatever subsidization that they can utilize to somehow offset those profits and disincentivize those energy companies to reinvest and ultimately produce more. So is your question, where is their incentive? Is that ultimately what I want to be clear, because we go in a lot of different directions with this.
Mm-hmm. I guess more so, if there's something that is causing inflation to go up, that is an inelastic good like oil is, because let's say just energy in general, that to me seems a lot harder to get under control than some type of good inflation where there is, in some ways you can live without it. In other ways you might be able to find a substitution for it. So in some of these examples, like I think energy is probably one of the best examples. How do we get around that idea that, or not the idea, but how do we get around something that is contributing to inflation that is necessary every day and also inelastic? Right.
So first things first, I want to specify that inflation itself is not sector dependent, right? Inflation, if we're going to generalize it as inflation is an increased quantity of the currency supply, increased purchasing power, increased ability of demand, and ultimately supply of anything has limited bearing, not no bearing. I mean, laws of economics, supply and demand should be relatively equal as far as their weighting, equally from the weight and the value that demand has versus the value that supply has. The inelasticity of something like energy remaining at a stable constant of production or availability does not cause inflation. What it causes is a price increase. And maybe for anybody that's not an economist or really focusing in the economic specification, that is a semantic wordplay, but it's really truthfully necessary to really kind of focus on, because the inflation is ultimately the purchasing power. How much money how much availability of demand is in the hands of people wanting a limited finite supply of something? And if you increase the quantity of their ability to buy, and you give everyone, Peter Schiff again loves to say that if you gave everybody $1 million, they're not going to be richer, because the prices of everything around them would just go up to compensate for the currency supply that they all suddenly have. So everybody wouldn't be able to just go out and buy Ferrari, because Ferrari can only make so many Ferraris per year or whatever per day. And their goal is quality, not quantity. So no amount of money is going to incentivize them. I mean, to a point, I guess, if you could somehow increase the value of the money, if you could increase the value at the same time that you increase the quantity, then maybe all of a sudden Ferrari could open 1,000 Ferrari factories and increase their output exponentially. But they're
then
not going to do that.
Supply and demand comes back into that picture again, right?
It should, because there's still a limited supply of the goods and the materials that Ferrari would need to produce that increased quantity of those vehicles. Mm-hmm. So their costs are going to go up. And if the value of the purchasing power of the buyer of the end product of the Ferrari somehow goes up, that value is going to get transferred to the end user of the materials that Ferrari is buying those materials from, right? So it's nonsensical, because you can't really increase the value you can't increase the value by increasing the quantity, because increasing the quantity decreases the value, decreases the purchasing power. Mm-hmm. So to say that we could somehow increase the quantity of the currency and also simultaneously increase the value of that currency is, again, economically nonsensical. Mm-hmm. So there's no way to equitably, there's no way to balance that equation. So when it comes back to your question reiterate your question one more time, just so that I'm 100% clear, because I really wanted to hit home the understanding that, inflation is not sector dependent, and there can be sectors of the economy that experience higher prices, and it's called inflation. Mm-hmm. But again, inflation is specifically the purchasing power, demand, availability of the consumer to acquire, and whether or not they direct their purchasing power to that specific sector. That's a psychology, or it's ultimately economics. It's a praxeological argument from Ludwig von Mises. How would you say it's not a school of economics, but it's a field of economics. Praxeology is economics and history, and it's a praxeological argument. Ultimately, it boils down to the psychology component of the individual as to why they would direct their purchasing power to that sector. And in this case, the psychology behind why energy is, it's relatively obvious. Most people require it in the modern day. We need it for heating. We need it for transportation. We need it for energy. Energy being electricity. A lot of electricity comes from burning fossil fuels or whatever. Mm-hmm. So the psychology of that's not too difficult to understand. But when you provide people excess liquidity in the form of demand and purchasing power, and then they can use that to bid up prices in energy, the logic would dictate that the producer is receiving more money, right? They're receiving more profits as a result of acquiring this purchasing power, this demand, right? This money that they're supposedly getting. But you still have to recognize the fact that the increased quantity of that currency has devalued the overall value of the buying power of that currency. So even though they're getting more of it, they're getting more of a lesser value. So A, they're getting more of a lesser value, and B, they're being penalized or threatened of penalty when they supposedly earn profits. So if you were an individual that was required to go, or you were a business or an agency or a corporation that was trying to produce something that people needed, and they were giving you their medium of exchange in exchange for that thing, but what they were giving you was devalued relative to what you're theoretically accustomed to its buying power being, and you're being threatened to not produce, what are you going to do?
Yeah, not produce and not reinvest in those markets where you are being threatened, right?
That's the only logical outcome that I can equate to. Yeah, I don't know, unless you want to take the risk, right? Mm-hmm. You're going to take the risk and barely break even. And at the end of the day, your cost inputs are going to go up because there are costs associated with producing and exploring and all of that. And so if your cost side goes up and your profit side remains stagnant, you operate at a loss. Mm-hmm. If your costs go up a lot and your profit side only goes up a little, you're operating at a loss. So if you want to take the risk of operating at a loss to somehow make it up on volume, which is the standard Keynesian model that I think most modern individuals are familiar with, that we can sell $1 for 90 cents and make the difference up on volume, by all means.
Mm-hmm.
I don't know how that works.
But I'm not that smart. It makes sense on a macroeconomic level. You wouldn't understand anything about that though. Like, it's super complicated. You can't think about running a country like you can a household where you're trying to balance a checkbook. It's super complicated stuff. You wouldn't get it. We have many highly trained economists working on this stuff, and you best just leave it to them, right?
Right. And that's what we're told. And that's what we're expected to believe. And we're good sheep that do as we're told. And we trust that the parent company agency of the government knows better. And we're supposed to shut our mouths and go about our day. Right. And I just push back on that.
Mm-hmm. Jess, I want to get your thoughts on if that's what, originally makes gold such a good form of money. Obviously, Mike Maloney is famous for making that very, very pertinent distinction of or between currency and money, right? It seems like we keep hearing about all of these fiat currencies going to zero and coming to an end. You and I have talked a lot about, and I have many conversations about the idea that currencies are changing. The reserve currency of the world is changing dramatically at this point in time. So is this what initially made gold such a good store of value, and that's why people decided to ultimately trade and use it as a backup value for fiat currencies for so many years now?
Maybe. I personally, for me, this is a complicated, it's depends on which way you look at it, I guess. For me, what makes it, I guess you have to make that distinction of currency and money. And is currency simply a unit of account that is used in transactions to represent buying power as a stand-in for that which actually has the value that you supposedly have access to somewhere that isn't here right now in the immediateness of the transaction? So currency, historically, as we understand it, the dollar was fixed. The dollar was gold, right? Or silver, depending on when and where in history you look. According to American history, we can go back as far back as we know, as far as transactions take place. We'll just stick with American history for now. The dollar was gold. The gold was the dollar. And when it became easier, or was always easier, to transact not using gold coins or gold bars to make a transaction in, because you don't want to lug around this big heavy object, or silver, which is even heavier because it's somehow less valuable. How you can look at 5 platinum group metals and call them more valuable or less valuable as relative to their supply, I guess. And that's an argument for another day. But why we are using currency in the form of paper or digital numbers to signify a medium of exchange is because the currency is a representation of the actual money that's in the vault or in the bank or at your house that you're claiming that you have, and you're essentially transacting against the value of that money, gold, silver, whatever, and you're saying that you're good for it, that you actually do have that money somewhere and you have access to it, and it's going to be transferred later. The immediate currency transaction, medium of exchange, is just to represent when you go to collect. So if I hand you $10 100 years ago, I'm handing you $10 worth of gold. So you go to the bank and all of a sudden I've given you $10 worth of my gold. So you go to the bank and you say to them, I have these $10, which prove I have the right to pull out $10 worth of gold. And they would take your receipt, your dollar, which is the receipt of the transaction, and they would give you the gold in exchange for it. Mm-hmm. Now, why is gold money, or why does it hold value, or why is it better than anything else? I mean, there's the physical properties of it. Why? For me, what really is more than anything the component that makes money is that it's a fixed quantity of a thing, ultimately, that has characteristics that can be demonstrated as a functional value that the majority of people can agree upon in terms of identification, use,
authenticity.
Sure, rarity, right? And all of those things. But the one reason why governments use money instead of something else historically has been because it limits their ability to spend. And that's the key thing for me, that what makes money is that, or not necessarily what makes it money, but why governments have been assigned with using money in our world. That makes sense. Or of course governments use money. Well, what else would they use? That's a possibility of understandings that most of us can't even wrap our heads around. But the reason they use money is because it's a limited availability of their access to spend. And when you constrain a government from spending, they don't spend beyond their means, right? It's not a household that has gone millions of dollars into debt and somehow needs to come up with that money, right? So you only spend what you have. And that has been the argument for why governments need to use money. And the thing that seems to work best is this tangibility of gold as existing as a purity, a rarity, a finiteness, an identifiability that you can look at it and weigh it and perform chemical observations of in order to be certain of it. And that allows them to spend what they have. And I guess ultimately at the end of the day, money it's a psychological phenomenon of everyone agreeing that what they constitute as money is money, and that it has the value that they claim it does. Mm-hmm. And I think ultimately a lot of people probably are thinking what I'm thinking right now, is that what makes that different than Bitcoin, blockchain, any cryptocurrency that operates on a blockchain. It's a limited quantity. It supposedly is rare, right? There are the element components of it that exist of the definition of what I've just outlined money as being. My thing is that gold is not reproducible, supposedly, right? You can't just go out and make gold. I mean, you can mine it. One would say that China is the world's largest gold producer. And I actually had somebody ask me a while back, how do they produce gold? How are they making gold? Well, they're mining it, and they're mining it in such insignificant quantities relative to the material that they're pulling out of the ground. But they're producing gold into large bars that, they then have gold bars of. Mm-hmm. But you can't just go out and fabricate gold out of thin air. But Bitcoin, no, you cannot recreate an exact likeness more Bitcoin, right? There's a limitation on the 21 million of it. Mm-hmm. But it's open source, right? This is the whole point of Bitcoin. It's open source using the technology of the blockchain, which makes it infinitely reproducible. And that's the characteristic that excludes it from being money. You cannot just claim something as being money when it is infinitely reproducible.
Well, I guess the pushback on that would be the network effect and the fact that so many people have chosen to value that. And in a lot of ways, I guess you could make that argument for sovereign or national fiat currencies as well. The only thing that is holding that up is holding up that value is that confidence from the people that are using it and transacting with it to accept it from both sides as both as being paid for something or paying for something with it, right?
Yes and no. No, because that meets the criteria and characteristics of currency, but not money. Because in order for something to be money, it has to check every single box of the characteristics of what constitutes money being money. And the one characteristic that Bitcoin or any currency, fiat or sovereign debt or whatever, doesn't check is that there isn't a way to guarantee that it's not reproducible. Who's to say that I can't go out? I mean, yeah, the government makes it illegal for me to go out and print my own dollars, but who's to say I can't?
Mm-hmm.
It is reproducible. It may be against the law, but I can do it. But I can't just go out and magically print gold, right? I can't just extract gold from the air.
Mm-hmm.
I can't manifest it into reality. And because Bitcoin doesn't check that box, because it is reproducible in another variation, it may not be exact likeness. Mm-hmm. My printing of counterfeiting dollars would not be exact likeness, but it could still theoretically pass as currency in a transaction. And someone may be fooled into accepting it. But that doesn't make it the dollar, but it also doesn't make it so that I can't use it as a dollar. So to say that Bitcoin, that I can't use a variation of Bitcoin on the blockchain of a different cryptocurrency, sure, it's not Bitcoin, but it has most of the same characteristics. It looks and smells like Bitcoin. Mm-hmm. It just is called by another name.
Wait. What do you mean looks and smells like? I don't think those are I don't think those are properties that Bitcoin has.
It passes the proverbial sniff test, right? And so for me, it doesn't check that box where it needs to be isolated and stand upon its own existence, where you cannot manifest and reproduce it in a variation that passes the sniff test. Mm-hmm. Now, supposedly, the argument could be that China was selling tungsten bars coated in gold and it was passing the sniff test. For a while it was. And that's really not different than counterfeiting dollars. Mm-hmm. Same premise, same concept, just a different material. Tungsten is not gold. And there's no way to make it gold unless alchemy is the thing that I've missed.
Well, I guess the other part of Bitcoin that is, as I started learning about it, and when I put some money into it, I really believe in the idea that we do need some type of a currency that is not centrally controlled, not controlled by a particular entity who can just print more of it because they, like you say, they don't have the constraint of supply. The distributed nature of it and distributed immutable nature of it, I think, are all pluses for it. And I don't think the world is worse off for having other types of currency, other alternatives to dollars, any type of a competition against a system that people are starting to lose confidence in. I don't think is a bad thing, because people need to start realizing that they can vote with their dollars, with their behaviors, with their actions. Personally, I think that's a really, really important concept. And I guess you could almost make the argument that a couple of years ago, it was easier to be able to vote in some ways by using different forms of currency. Now, when, the IRS, for example, is scrutinizing you for a purchase over $600, that argument can definitely be made for this point in time. But the bigger point I'm making is that we need some type of a challenge against these traditional fiat currencies or these legacy systems that, you and I have grown up using, because the more comfortable we get using those systems, the better we get at using them, the better those systems themselves get, whether that be, somehow using gold or silver to transact, whether it is some type of cryptocurrency or blockchain technology. I think we need to start getting more people exposed to these ideas, because trying to save over the last 40 years, never mind 2 years, just in dollars has unfortunately mostly been a fool's errand unless you were in the US dollar. But again, in some ways that's almost making a trade. I've shared the story a couple times on the show of having my grandma give me original $100 bills from, I believe they were from 1979. And just for the illustration of the exercise, I went through with her and we calculated the inflation rate or the devaluation rate of that 100 Canadian dollars, in my case, over those years versus what that same $100 would have been worth in gold. And it blew both our minds, right? It's just a slope down and to the right for value of the dollars versus a slope, a much steeper slope up and to the right for the value of gold if you would have bought it at the same time. Obviously, you can kind of cherry pick points of time for when that was great, and you could also cherry pick points of time when that worked against you. But again, I don't think it's ever going to be a bad thing for most people to be more exposed to the idea that your purchasing power is being destroyed, that the idea of sound money is an idea we need to return to. And I've made the point so many times that to be heading in that direction, we're never going to be worse off for making those changes and implementing those changes in our lives.
You're absolutely 100% correct. Everything you said is spot on. Differentiation and the distinction that exists for me and what's necessary on a governmental and global scale isn't that having a decentralism of currency is bad. It's when the currency takes the place of the money. That's when the problem globally, governmentally becomes problematic. My issue is that if the cryptocurrencies stand in for money the way that the fiat currency of the dollar has stood in for money, we're just swapping the understanding of one for the other, the dollar for the crypto, and nothing has changed. Mm-hmm. On the money side. On the currency side, like I said, you are 100% correct. In fact, the more currencies, the better. It's like saying the only currency in existence should be the dollar. Well, that's ridiculous. I mean, it's the reserve currency, and it's the one that a lot of things are transacted and settled in, but it's not the only one. Mm-hmm. And if it were the only one, then that's a complete autonomous measure of control that the issuer of that currency has over every government, every individual, every business, every corporation, every agency on the planet. And that's the argument for decentralization, decentralism in the first place, is that central forms of power are totalitarian. And that's the point I make in my book. The whole point of the book is to try to get the reader to understand the nature of authoritarianism and totalitarianism. And the book is titled The Real Truth About Inflation. And then the subtitle are How to Spot a Socialist and Understanding Central Planning in the 21st Century. Mm-hmm. And the whole purpose of the entire book is to try to get the reader to recognize that centralization and centralism are the most dangerous elements to being alive, because that central authority, that central control, when it has total control, I mean, we don't need to go very far historically to look at examples of authoritarian and totalitarian regimes that have never resulted in good outcomes, right? I can't point to a single one that I can go, you know what, that one succeeded. Mm-hmm. So when it comes to the currency side of that, what we're arguing for is the equivalent understanding. Do we want totalitarianism and authoritarianism in our currency? And whether we're using digital, blockchain-based, decentralized, distributive ledger currencies, or we're using paper currencies, what's the difference? The issue is whether or not there's one or as many as there should be. And ultimately, more is always better, as long as they meet the criteria of currency.
Yeah,
Right?
I think that's the important caveat there, is that they serve a particular purpose. Because I mean, whatever it was, I can't remember what the total number of cryptocurrencies was, but it's hard to make an argument that there's a use for all of them.
Yeah, it's the free market is the arbiter of that determination, right? And so in a free market, as long as the thing that you're claiming is what you say it is, meets the criteria and checks the boxes of it being that thing, then there's no reason why it shouldn't be that thing. And however many there are of it is irrelevant, right? As long as it fits the parameters, then it fits the parameters and it is that thing. So in the case of currencies, if there's 20,000 digital cryptocurrencies and all of them meet the criteria of currency, who's to say that's not too many? What the free market determines as being the top 10, top 100, the top 5, the one that seems to be the reserve currency is apparently humans need. I don't know why. I guess because somebody needs to be in control for reasons that don't make sense quite to me. But that component aside, the understanding is that more is always better as long as they fit the parameters. Less is never better. Less choices are never better. Right. And that's the argument that America historically existed upon, was that you had the freedom, first of all, and then supposedly you had the freedom of choice. And then the purpose of capitalism, free market capitalism, was that you could create a better variation of that product than your competitor and offer it at a cheaper price, a discounted price to them. And that if you were able to do that equitably, then the consumer would come to you and not your competitor, and you would advance your enterprise and theoretically become profitable. And the consumer, as you said, would vote with their dollars or vote with their purchasing power, and they would choose the winners and the losers. The problem is, of course, that today that's not really the case. When you have an issuer that issues the currency and controls the value of it due to the quantity of it, and the individuals that have access to it, according to the Cantillon effect, which are the people, the Cantillon effect, in case anyone doesn't know, is the first receiver of newly minted currency, has the most purchasing power that quantity of that newly minted currency is going to have, because the moment that it hits circulation and supply, it devalues the rest of the currency in supply and itself. So that currency supply, or that newly minted currency in supply, only has that purchasing power that it has that first time. And so when the people that have access to that newly minted currency are friends or beneficiaries or agencies that are in cahoots with the issuer, they are most likely going to get that purchasing power before anyone else, which is going to direct the outcomes of where that currency is directed to, right? So if you have a bunch of member banks, for purposes of examination, that are friends or party to the issuer of the currency, they get that currency in huge quantities at no cost, essentially, and they get to direct all of that newly minted currency to whatever ends that they choose. And if the people in control of those member banks are not, shall we say, honest or good intentioned, then maybe the direction of that currency will go to places that it shouldn't.
Yeah, so many things to take into consideration here, and the way that money has behaved, or let's say currency has behaved in this zero interest rate environment, QE environment, has really driven, because returns have become so difficult to achieve in these low risk environments, it has driven people up the risk curve. And then when you throw interest rates, the wrench of interest rates going back up, everybody's used to this environment of unlimited QE, zero interest rates, unlimited liquidity in the system. all of a sudden this completely changes that paradigm and really throws the entire thing on its head. And unfortunately, that has, I think, probably hurt a lot of investors, or if you want to call them speculators, because that entire paradigm has been instantly changed. It'll be interesting to see what happens as all eyes are always on the Fed, and especially right now. The Fed really has trained people to do that. And the next time that they announce that they're going to be either cutting or even just backing off, it just seems that every single time the Fed investors, the market responds so positively to that. Because if March of 2020 taught anybody a lesson, it was that you need to be ready with a lot of cash and a lot of dry powder when the Fed says, party's back on, guys, let's go.
Right. So that is the conventional position and relative recency bias of what constitutes modern day logic, right? Relating to the stock market and QE, right? I push back on that because first, if you look historically at every time the Fed has cut rates, often as a result of recession, it was not until, Lehman Brothers collapsed September 15th of 2008, I think. And the Fed cut rates whenever they did. And it wasn't until they cut rates that the stock market up until that point, the stock market had only fallen 13% up until Lehman Brothers. Once they cut rates, it fell another 45%. We are trained to do this thing, but here's the thing that the recency bias seems to have been forgotten. The stock market started its downturn last year when Bitcoin was at 70,000 and it started coming down. The stock market started its downturn before the Fed started hiking rates. And there was the point at which it started before the Fed even came out and said that they were going to hike rates. Mm-hmm. And that was because inflation was getting out of control. Well, if the Fed cuts rates and goes back to QE, doesn't that mean inflation is going to really get out of control?
Well, that's why I think they're more worried about not going far enough, not changing behavior enough. And they would, as has been said many times, they want to try to get ahead of inflation. And this wealth effect, this positive wealth effect, is not as strong as the negative wealth effect of people losing, or that balance of positive and negative wealth effect is the line that they're trying to tiptoe, right?
Right. And so this is ultimately what gets us to what's known as the liquidity trap, mm-hmm. which is a contradictory economic situation in which interest rates are very low and saving rates are very high. And what it does, and that is kind of where, for a moment, where we were after COVID, right? Because mm-hmm. interest rates got cut, saving rates were the highest they had been since when? Now that's not necessarily the case. Savings rates are the lowest they've been since 2005. They're at 2.3% and falling. But the liquidity trap doesn't necessarily have to maintain those parameters throughout. So the liquidity trap is the rates are low, savings rates are high, and this renders monetary policy ineffective. So we'll go back to the fact that the Taylor rule renders monetary policy ineffective at negative rates when combined with asset purchases. And now the liquidity trap renders monetary policy ineffective altogether. But the liquidity trap also perpetuates a recession because rates are already at or near zero. Now, historically, some might push back and say, okay, rates aren't near zero. Are they really not? Historically, they're not that high. And they've gone up very far, very fast from where they were, and they were at zero. So that, for me, it just screams red flags. And I encourage anybody that wants to is to look up what a liquidity trap is and read it for yourself. The other component of a liquidity trap is that consumers hoard cash instead of bonds, which is what we're seeing, right? Because the reason that the bonds are up in terms of their interest rates is because nobody's buying them. Everyone's hoarding cash. The dollar has previously been at or near all-time highs, and bonds are fighting the 40-year trend that they've been in for the last 40 years. Screams a liquidity trap to me, combined with the Taylor rule, which says that raising interest rates, unless you go above the rate of inflation, won't change behaviors. So they're going to, what you said is they're afraid of not going far enough. The problem is that they're not going to go far enough to change behaviors, but due to the total quantity of the debt, which we can look at the debt in subsects of categories, but if you just look at the national debt, the 32 trillion. Okay, so 5% on 32 trillion is $1 trillion a year in interest. That's a quarter of your tax receipts. What point does that become unsustainable? You're going to cut taxes. I know you are, because when you go into a recession, you don't raise taxes. So we're going into a global recession. Who's going to raise taxes? Nobody. So interest rates, just the interest on the debt is going to be a quarter of your total tax receipts. You're going to cut taxes. So now you're going to bring in less income, which is going to raise the total quantity of the percentage of that trillion to a higher valuation. Mm-hmm. In order to finance that payment on the interest on the debt, the only way that that's going to happen is to borrow more money, right? Well, when you do that, the total of the debt goes up, which means the total on the interest goes up. Well, if you're cutting taxes and your productivity falls and you're increasing your debt, eventually that once you cross a certain threshold with those components in place, the interest accelerates. The interest on the debt accelerates. So it'll go from being a quarter to a half in a fraction of the time. And it'll go from being a half to a total in a fraction of that time. So you'll be paying $31 trillion a year or $40 trillion a year just in interest in no time flat. Mm-hmm. So whether they're going to go far enough to change behaviors, no, because people still need to eat and they still need to have a place to live and they still need to have their energy. So they're going to do whatever they can for as long as they can to keep financing that, whether it's through borrowing, which is only going to push up the total debt, and the interest on that debt as it goes up is going to become more unmanageable. And so while you're not changing behaviors, you are crashing the economy. And when you crash the economy, what does that do? Well, people get laid off. So people don't have jobs. They still need to buy stuff. They're still able to finance it for whatever reason that doesn't make sense to me by borrowing. So they're still going to be able to acquire without producing. The so-called producers or the businesses that exist as the economy as we understand it, it's the stock market, but they're almost one and the same at this point. They stop having they stop having employees who can do what they need to do, but they still need to exist as an agency. But if you don't have workers, then how are you able to do what it is that your business claims to do? I don't know. And on the scale that supposedly that they do it as, I don't know. So at that point, either you're outsourcing it all to China, and China is producing literally everything, and you're paying them in money that you're going to devalue, or currency that you're going to devalue by printing, which is going to make it completely worthless. So they're not going to want it. So the incentivized structure of what we were talking about with the energy companies. Well, if the energy companies are not incentivized to produce more, what's the incentive for China to produce more? Mm-hmm. I don't think there is one, because they don't want our worthless dollars, because the only thing that our worthless dollars are giving them is purchasing power to buy things. But if our dollars of purchasing power aren't worth anything because we've devalued them because of everything that I've just said, then those dollars are no good to them.
Well, and they're certainly trying to move away from that to transact in energy in their own currency, and any other currency that they can. And I think that this makes a good argument for the idea that this isn't a momentary change that is going to take place in the dollar, right? This is a change that takes a long time, as it took a long time to implement the US dollar as the global reserve currency. It's going to take a long time to transition away from that. But if you look at the way the US has used the dollar really as a baseball bat to the rest of the world, that really incentivizes the rest of the world to find alternatives for it. And until that time, I think China is going to continue, obviously, to keep taking dollars for the goods that they produce. They're going to be happy to take dollars, but ultimately, after so much abuse, people are going to, or other countries are going to start finding ways around that.
Right. And I think the question that needs to be asked is, what is China buying with those dollars? And how they're allocated. They're not only buying one thing. It's not as if they're receiving, the $100 billion or whatever our trade deficit is, which is mostly with China a month, but the United States trade deficit with China. It's not as if they're taking that $100 billion and only buying one thing. They're not. But we have to assume that they're taking a significant portion of those dollars and buying gold with it, right? Because we know they're the world's largest producer of gold, and they're also the world's largest buyer of gold. And so they're taking our dollars and turning them into gold. And the reason that they're doing that is because China is energy dependent, because they got 1.3 billion people, and they need to provide energy for their people. They need to provide food for their people. You and I had a discussion in one of our previous talks in the last couple of days about what it is that props up the value of the dollar, and it's the petrodollar, right? Oil, essentially, that and the decree of the might of the military, but the might of the military is only protecting the petrodollar. We're not using the military to war into other, because if the United States actually had to go to war with every nation that wanted to fight it, it wouldn't be long for this world. Mm-hmm. What the United States military is really doing is protecting the underlying value of the dollar, which is oil. And the reason that the value of the dollar is denominated in oil is because of the petrodollar and the agreement with Saudi Arabia, or the OPEC nations in the 70s, about pricing oil only in dollars. So all oil on the planet has to be transacted in dollars, which creates the component element of Brent Johnson's milkshake theory that there's demand for dollars, and mostly due to oil. And as long as oil is needing to be or being enforced and protected by the US military to be transacted in only dollars, then there's value and demand for dollars. But that transaction, that exchange of dollars for oil, is difficult and expensive for countries like China to do, because in order to get the dollars, they have to basically enslave their population to make stuff that we buy from them, mm-hmm. that we can then send them dollars. That's expensive. It's expensive to enslave people. It's not cheap, and it's expensive to make them make stuff. And yeah, they can make. It's cheaper than paying them, but it's still expensive. Mm-hmm. And there are cheaper ways to acquire oil than to enslave your people. And so what are they doing? They're playing the long game, right? They're acquiring dollars from us by making trinkets and televisions and whatever else that the Americans want. And we send them dollars, and they go out and allocate those dollars for the acquisition of whatever it is that they're buying. And then, in some cases it's gold, in other cases it's concrete, and they're building these. If anyone thinks that these ghost cities are a mistake, they're not looking at the long game. These ghost cities are going to get filled. We're just not there yet. They're doing this in advance, in expectation of what's coming. And so China is going out and buying all this stuff, and part of it being gold. And the reason for the gold, China doesn't want gold. China wants energy. China wants oil. Who wants gold? That's the question. Well, we know the Saudis are gold obsessed. We know the Iranians are embargoed up to their eyeballs by the United States. They're not allowed to transact in dollars, or they're not even allowed to sell oil in dollars. But the Iranians have tons of oil. that they're just sitting on. And the Russians want gold. Putin wants gold. Why? I don't know. Who knows why? I don't know what his plan is, but he's doing something. But he wants gold, and he's got a bunch of oil too. So that means that the oil producers want gold, and the largest gold holder in the world wants oil. And right now it's illegal to transact in anything other than the dollar. China's been building up its military. It's been building up its infrastructure. It's been building up its workforce. I mean, yeah, there's an element of the demographic that maybe their workforce is getting a little older, but they're a hell of a lot more productive than anyone else's workforce. And they're a lot better at it than any of the rest of us. They have the know-how. They have the means. They have the materials.
They have the infrastructure.
They have everything. And we're going to sit here and point fingers at them and say that they've been playing the same game we've been playing as far as devaluing their currency and running up huge debts on these, in their banks and in, things like Evergrande and whatever the other one is. And who cares? That's their checking account, right? All of that stuff is their checking account. What's in their savings account?
Well, they haven't declared that, right? And that's their, I think their strategic plan is to use that or to be able to declare that at a time that works for them, right?
Right, but it doesn't take a genius to figure out that they've got everything in terms of all of the materials, all of the infrastructure, all of the workforce. They've got how many ships do they have? I don't mean naval ships as far as like military. How many ships do they have to send all of their goods around the world? What's their rail network look like? What do their highways look like? What do their airports look like? They're a hell of a lot better than anything in the West, and their people are all on board with it. Mm-hmm. I mean, what population as large as China doesn't push back on being locked down for 2 years? I mean, at some point, supposedly, historically, you can only oppress and keep people down for so long before they revolt and rebel, right? But they're not really, not collectively. So they're kind of either on board with it or they're so brainwashed that they're just going to do what they're told. But either way, the outcome, it's a distinction without a difference.
I think that's a fair point.
And then the outcome is they have all of that, and now they need oil. Well, the people that have the oil want the gold, and we know that the OPEC nations have basically said they're no longer going to uphold the petrodollar. So that's a shoe-in for me. If I'm looking at that equation, China's in. Trading gold for oil, they win.
Mm-hmm. Yeah, kind of to summarize that point, really, it's gold / money is power. And you can get whatever you need and want with that purchasing power, that value. And it doesn't matter that it necessarily needs to be oil or gas or more rare earths or more infrastructure, whatever it is. If you have a badass savings account, you can do whatever you need to do, pretty much within reason.
Right. And it always helps when you have friends too, right?
Yeah, absolutely.
And China seems to have found some friends.
Well, I think you could say that about Russia as well in this at this point in time.
Absolutely. And Russia doesn't have anything on the material side or the military side either, right? They've got, I mean, we can sit here and laugh at Russia's military, but I wouldn't want to fight them. If I were the president of the United States, I'm not going to war with Russia. Mm-hmm. I wouldn't want to go to war with a beehive. I might live through it, but I certainly wouldn't want to do it.
Yeah.
Just because they can't kill you doesn't mean it's not going to hurt unbelievably. It's bad logic if we're going to sit here and down talk them and pretend as if they're, incapable of performing an immense amount of harm and hurt. And they're already demonstrating that they don't need to use their military against us specifically to enact that hurt, right? They're using the war in Ukraine as a way to cause the United States to impose sanctions that benefits Russia. How dumb are we?
Yeah. And it just seems that the sanctions, as George Gammon always says, everything in economics is always a trade-off. And these unintended consequences of the sanctions really, if we take the example of China starting to buy a lot more of Russia's energy or whoever it's going to be, the effect that the ruble or the outcome of the ruble since the first sanctions, there's a bunch of different things that I don't think we can objectively say has made Russia much worse off since the sanctions have been imposed. It's just a matter of it has changed who they're dealing with a little bit. And I think they're carrying on producing what they need to. At the same time, it might be a relatively small quantity to comparing, them to, let's say, the US or maybe Canada. I'm not 100% sure on the exact numbers of that, but at the end of the day, it feeds their economy enough for them to continue down the path that they're on. And it didn't cripple them as the sanctions were really intended to do, right?
Well, it certainly didn't cripple them. And I would push back against anyone that says that their total impact of their energy is not as great as the United States or Canada or Saudi Arabia. Maybe not.
Yeah, well, that's what I was going to say. The relative number is smaller. However, because of the inelasticity, the inelastic nature of that commodity, they do not have, the world doesn't have the ability to just shut that side of supply off and have no effect on the world economy, right? If Russia,
we're still not in winter, right? It's just barely December. Winter doesn't really start until, Christmas, effectively, right? Because that's, if you look at the actual season, winter doesn't start until December 21st, the solstice.
Well, I would push back on that and say,
well,
the foot of snow, the foot of snow out my front window disagrees with you.
I'm not saying there's no snow, but winter hasn't really set in. And, it might be cold, but it's not -20. Is it -20 where you are right now?
Yeah, it is.
It's -20. For real.
Yeah.
Holy shit.
It's gonna warm up a bit tomorrow, but
so what?
Yeah, I mean,
I guess,
so far it's actually been a fairly, since the cold weather moved in, it's probably been about a month now, and below freezing, and we really haven't had much of a reprieve from that, where we actually normally do warm up quite a bit. The area that I live, there's warm air that comes off the mountains and warms up our this area for a couple days at a time. We can have such drastic temperature changes. We can have a 40-degree difference between 2-3 days. It'll warm up, melt some snow, give you a nice couple days, and go back to being reasonably mild. But we've had probably a month so far of pretty cool temperatures already.
Wow. Is that normal at this time of the year, or does it usually come a little later?
Fairly, but like I say, the normal side of things is when we get these small breaks from the cold temperatures.
Right. Well, I don't know what the temperature, I haven't looked at the temperatures in Europe, but I would guess they're not in their cold spell yet.
Yeah, I would agree.
Maybe I'm wrong.
Mm-hmm.
So for them, winter hasn't started. So the demand element side of the oil that they are not going to be receiving due to the destruction of the NordStreams from Russia, those impacts still haven't happened yet. And like I said, China and as you said, Russia have found friends. Well, the United States and the West are about to lose their only friends, being Europe, right? Because as soon as they start freezing, cold really makes you really kind of simplifies things, right? Being cold sucks.
Mm-hmm.
And being really cold, you don't care where the heat comes from at that point, as long as you get warm. Mm-hmm. And if you have to alienate your only friends to not die, I think most people take that choice.
Yeah, and that's the thing. Like the sabotage of the NordStream pipelines, whoever you want to blame for it, really took a lot of choices away from Germany and Europe as a whole to be able to, maybe broker some type of a negotiated peace agreement. Whatever it is, that took a lot of choices away from millions of people.
Right. Yes, it absolutely did. And to say whoever did it, I don't think it really matters, because at the end of the day, I think it was all part of Putin's plan anyway. He factored into the equation that if he went into Ukraine, whether he did that, whether he blew them up himself or someone else did, they were going to get blown up. They were going to get destroyed. It was all part of his plan, and it's working. And at this point, for anybody to question his plan as being as successful as it's been up to this point, he's still going.
Yeah, I think, I don't know. I tend to disagree with the idea that might have been part of Putin's plan. Like if you're dependent on trying to sell energy to Europe and you don't necessarily want to step on that lever as hard as you can, which I don't believe he was at the time, then that doesn't necessarily make sense to me. But to say that he didn't think of that as being a possible outcome of the invasion, I think you'd be silly to make that assessment.
I mean, you could be. I mean, you could be right. Given the close relationship that Russia has developed with China and Xi specifically, who knows who's taken whose advice about what at this point. And if Xi went to Putin and said, you know what, hey, what might be a great idea? Blow up your own pipelines and they'll become unbelievably dependent on you. And that's the long game, because we know that China plays the long game. And if I'm Russia, I'm going to listen to China because they seem to be winning. Maybe their checking account is in the negative, but their savings account and everything else, they're doing great. So if I'm Russia, I'm listening to China, and whatever advice they're given, I'm taking. Mm-hmm. And if that's, Xi is, he's about as cunning as it gets. You don't get to where he is by being a fool.
Absolutely not. Well, J.E.S, it's been a really interesting conversation with you. Is there anything else that we should touch on before we wrap up here?
Probably, but I guess the one thing that I want to really clarify that maybe we didn't really talk about is the supply chain root cause, and why supply chains are the way they are right now, and why there's, I think the one thing that always gets overlooked, and for whatever reason, I don't know, it's not a supply problem. It's a demand problem. We've given too much buying power, purchasing power to too many people, and they've bought up all the availability. And to say that prior to doing that, there was no such thing as a supply problem, and then all of a sudden doing that results in a supply problem. Yeah, I'm going to push back on that. I'm going to say, you know what? I don't think so. I think you have a demand problem. I think you've created a situation where unless you have infinite supply, which is economically usually impossible on a finite planet with finite resources and finite labor and robots not building everything all the time, 100% of the time, and all that stuff, I don't think it's a supply chain problem. I think it's a demand-driven problem. And every time I hear this supply chain nonsense, I just slap myself in the face and go, who the hell is believing this? How much do we not have to commit one iota of thought to what we're being told, to question for even a fraction of a second, to examine and look at a situation and understand it beyond the narrative that's being provided? Yeah,
I mean, I think there were times where supply was definitely hampered, but
So yes, I mean, things were shut down even in China. But I mean, maybe. I mean, I wasn't there. I don't know anybody that was. So we were told they were shut down. And by not, going along with this whole premise of not committing one iota of thought for even a fraction of a second to question the narrative, well, are you believing the narrative that they're telling you about China being shut down? I don't believe anything that comes out of China. Just like every time, like I said earlier, every time the government speaks, I just assume they're lying. Now, I attribute government to all government, not the United States government, not, just government.
Mm-hmm.
Any modern variation of government, anytime they speak, I just assume they're lying. Was China shut down? Maybe, maybe not. I wasn't there. Don't know anybody that was. Don't know anybody that knows anybody that was.
Again,
just taking it on good faith.
just controlling that narrative seems the best way to be able to shape the reality that you want transferred into the rest of the world, right?
Yeah. And they're pretty good at it because we keep believing it.
Well, not you. Nothing gets past you, J.E.S.
It doesn't seem to.
Why don't you remind everybody of where they can find your book?
Yeah, the book is, it's still, I haven't, I was moving for a couple of months and my focus was not on working on the book side of things. So the book is on Amazon Kindle. I'm going to try and get a paperback version of that out. I know I prefer to have physical books in my hand. I don't like reading on devices, but it is on Amazon Kindle. It's still, I think, at the $2.99 price. I think that's the lowest price Amazon allows to sell books. And for now, that's where it is. Again, I'll put out the same offer I did last time. If you can demonstrate a receipt purchase from Amazon, I'll shoot you an email of the original PDF, because Kindle, for whatever reason, the operating system of Amazon's Kindle is looks like it came out of the 1970s. So a lot of the font styling and some of the I put in some emojis and some graphs. They didn't quite translate into Kindle's formatting. So if you can shoot me an email with a receipt that shows that you bought the book, I will shoot you a PDF of the original, and that can be, the email is aueconjes@gmail.com.
Perfect. And we'll put that in the show notes as well. Jess, thanks for going over all these different ideas with me today.
Thank you for putting up with me and listening and talking. And it's awesome to have you and Palisades to be able to do something like this with, because you guys are really the engine that drives the freedom that the rest of us so desperately need.
Well, I hope so. And I hope that that's just for nothing else, to be an instrument of expanding some of our horizons, to be an instrument of good. That's the whole reason we do the show, and why I put so much work into it. Thanks so much, J.E.S.
Absolutely.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.